Hey guys, Dave Keller here with Market Misbehavior. I host a closing bell show on StockCharts TV every weekday called The Final Bar. We didn't have a live show today, so I just wanted to share with you the 3 and 3. So at the end of every episode, I do what are called the 3 and 3, 3 charts in 3 minutes. It's trying to tell the story of this market environment through just 3 charts, try to make sense of the noise of the day and boil it down to 3 visuals. So here's what my 3 and 3 would have been had we done the show today. Chart number 1 is the Russell 2000 ETF, and I focus a lot on the S&P 500 and the NASDAQ, reasonably so, because a lot of passive investments are tied to those benchmarks. So I think it's important to follow along where they're at. And as you're thinking about your portfolio and managing at least a portion of that actively, that should be your benchmark. That's what you're trying to outperform, is that passive benchmark of the S&P or the NASDAQ, whatever you consider it to be for yourself. But I think it's also worth noting the Russell 2000 ETF, obviously vulnerable along with the other major indexes, but has a very different look to it. So while the S&P 500 made a new high into the beginning of this year, right? First week in January, you saw the S&P made a new all-time high before rotating lower, obviously continued to push lower through the course of 2022. The NASDAQ actually topped out in November, actually made a lower high in January before continuing lower. Small caps also made a lower high in January, and probably the most severe divergence of them all. So the S&P making a new high, the NASDAQ making a somewhat lower high, the small cap index actually making a significantly lower high. And while the S&P and the NASDAQ had been in a pretty good uptrend through the course of 2021, small caps really didn't participate much at all in 2021. So if you start the clock in February of 21 and you end the clock in January of 22, you literally went nowhere. This chart is unched through that whole time, unchanged. Now, obviously, a lot of movement. I have these purple horizontal lines to indicate that range-bound nature of the index. Now, I've run a Fibonacci retracement analysis using the low from March 2020 and the high from March of 2021, because that's what I see as the beginning or the end of the sell-off there in March 2020. The big bull run that you saw into the first quarter of 2021. And then really that was it. Now, it did make a higher high in November, but I don't see that as connected to this big uptrend. I see that more as a second phase. I think phase 1 is the uptrend here. Phase 2 is a consolidation phase. And this was just a failed breakout, a failed attempt to get above the highs from June of 2021. And then you have the breakdown out of that range. And I think that breakdown in January, breaking below a well-established level of support that was tested most months in 2021, finally broke below there in January, then retested it from below. And look how a number of times how we retest that breakdown level. From there, we've broken down yet again. Now, this pink horizontal line there, the dotted line, is a 38.2% retracement from March 2020 low to March 2021 high. So that's 38.2% of the way down. Just in the last couple of weeks, we finally broke down through that Fibonacci level. We're now retesting that level from below. The reason why I think this is an important chart to highlight now is if you look what this has done, I think it tells the story of the rotation of this market from bullish phase to sideways phase to downward phase, but also shows you that this is a fairly actionable breakdown just in the last couple of weeks. Now, this is coming off of March, when the Russell 2000 made its last run higher, and as it bounced higher in March, look at how the RSI failed right at 60, now rotating to the downside. So the RSI is oversold just recently, which would mean you'd expect at the very least a little bit of a bounce. That's what we saw going into last weekend and now continuing through today. But now we're testing that Fibonacci level from below. I would not be surprised if we would rotate lower. We have a new leg downwards. And if that would happen, what's next? That's where you have to go back to the Fibonacci retracements. Next support will be around 162. This is on the Russell 2000 ETF, ticker IWM. And then the next support, which I think will be a reasonable downside objective, would be around 146. That would be a 61.8% retracement of the way down. Sort of that 145, 150 range would be a reasonable downside objective if we fail to regain that support level around 178, 180. So that's chart number 1. Chart number 2, looking at year-to-date returns of some of these key asset classes. Now, I've handpicked some of them that I think tell the story of this market beautifully in the first, 3 and 4.5 months of the year. Here, flat for the year, right about, is the XLP. This is the Consumer Staples ETF. Now, if I told you at the beginning of this year, as the S&P is making new all-time highs, hey, good news, I have something you can buy and you will be flat for the year. When we check back in mid-May, you'd probably think that was a crazy bet. But think about how much better you would have done than owning the S&P or the NASDAQ or the FANG ETF, which is what we see below here. The S&P down almost 16% year to date. In purple, we have the technology sector, the XLK, which is down 22.4%. Here we have a FANG ETF, FNGS. We could use the Qs or something else as a proxy for that as well, but this is just a passive group of an index of those mega cap FANG stocks, down about 33% year to date. So Staples being flat is actually a pretty decent way to outperform year to date. And again, you've had a nice bounce higher in some of those Staples names. Charts like KHC and K and TAP and others have had some nice rotations higher, Smuckers and others. But at the end of the day, the sector is actually flat on a total return basis. Now, what are these that are way up here? So this is the XLE. This is the energy sector, up 51% year to date. This is the UGA, which is a gas ETF, which is up 75%. Now, there are a number of reasons why I think this is an important chart to think about as you're trying to make sense of this environment. Number one, look at this differentiation between what's working and what's not. When people say this is a bear market phase, you're right, but it depends on what you are considering as part of your universe. If you're talking about energy stocks or energy materials, cyclical stocks, those sorts of things, it's actually a pretty decent market year to date. 2022 has been fantastic. So I would argue this is a great, bullet point on the list of reasons why charts make a ton of sense. Because, early on in the year, when you saw technology struggling, you saw energy working. I remember being asked, did we miss out on the move in energy? And this is after some of these stocks have already had pretty good runs. The answer is, of course not, right? And never confuse the top of the page with support. Never confuse the bottom of the page top of the page with resistance. Never confuse the bottom of the page with support. I'm often asked in uptrends, did I miss it? I'm asked with downtrends, things you hold, did I miss my opportunity to sell it? And my answer always is, follow the trend. Even if it feels like the trend has been in place, that's okay, because over time, particularly if you're sort of an intermediate term investor, a couple months out, following the trend is arguably the best approach that you can take as an equity investor. So this shows you the gap between what's working and what's not. And it shows you that even something that's flat for the year at times can be a really good bet relative to, losing 20, 30% or losing zero. Losing zero seems to be a better option. Finally, my third chart to review today is Home Depot. You have a number of earnings this week, a lot of big box retailers like Home Depot, Walmart, Lowe's, and others. Important ones to watch because obviously they can tell you a lot about consumer behavior. They can tell you a lot about economic conditions and what consumers are actually doing and how these companies are planning for that and adapting to that. I think the chart of Home Depot is an interesting one because you're getting a bit of a bullish momentum divergence over the last couple months. So you have a lower low, February, April, May. Every month you're making a lower low in price. Every one of those months you're actually making a higher low in momentum, February low, March low, or April low, and May low. Every one of those times, the momentum is actually sloping higher. So lower price on higher momentum is often a sign of encouragement. It's actually a sign that conditions are improving because the selling pressure is being alleviated. There's less negativity. The relative strength has started to break above trendline support as well on some of these charts, which is why I think they could be compelling as well. Having said that, the trend is still down. So as a trend follower, I would be looking for signs of accumulation. So what would make a chart like Home Depot go from a clearly defined downtrend to a more encouraging sign of accumulation? Number one, we'd put in a higher low. Number two, we'd put in a higher swing high. Number three, we'd get above moving average support. So let's go through each of those very quickly. A higher low. So February to April to May, every one of those months, we've made a new swing low. We made a new low for the year. We have to stop doing that. I'm often told that flying is about trying to hit the ground and missing. A downtrend reversing to an uptrend is a stock trying to make a new low, but failing to do so, failing to make a new low and putting in a higher low, which tells you some buyers are coming in and appreciating the better valuations that they can get in on a stock like Home Depot. The second couple points would be get to a new swing high. So if Home Depot would get above these highs here, which are around 300, 305, 310 maybe, that would convert, or that would complete this rotation from downtrend to uptrend, meaning lower highs to higher highs. Finally, that would get us above Fibonacci resistance, but also give us above the 50-day moving average. And that's a key one. We broke down through the 50-day after testing it in December, broke down in January. From there, continued to go below the 200-day. Now we're below both of them. step one, get back above the 50-day moving average. We've failed a couple attempts to do that in the last couple months. Can we finally rotate higher? So I think those are key groups. That's a key group to watch. The big box retailers and consumer discretionary, consumer staples, all reporting earnings. Those could be a catalyst to push the price higher, or they could be yet another data point to reinforce this downtrend that we've been experiencing year to date. But the chart will tell us which is which. That was my 3 and 3 for today. If I had my show today, I'll be back live on my show Tuesday, May 17th. But until then, I hope you enjoyed these 3 charts. Do you agree with what these charts are telling us about the market environment? Let me know in the comments below. Also, give the video a thumbs up if you appreciate it. We'd very much appreciate that back. I'm Dave Keller with Market Misbehavior. Have a good one.